Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. On tonight's program, I'm going to do something a little bit different by looking at 4 stocks that haven't really done well in my portfolio recently, but I do think they have potential to do well over time. And as a long-term investor, I'm prepared to give these companies a bit of benefit of the doubt. And I think I'm supported by analysts who also think these companies have potential. Then I'm going to talk to Bill Evans, the chief economist of Westpac, to see where he thinks the Aussie economy and the global economy is going and how that could affect stock prices going forward. And Bill's one of the most respected economists in the country. His forecasting ability is accepted by government, Reserve Bank and whatever. He's a very worthwhile person to listen to if you want a bit of an indication of where we're heading. And then I'm going to talk to Michelle May of Michelle May Buyers Agents to get an idea of what's going on in the property market right now. She reckons that the buyers are starting to come back to the market. Auction numbers are on the increase, but also supply of property is on the rise as well. So what should happen to prices? Michelle is an expert in the market. Let's just see what she has to say. So without any further ado, let's go to my little presentation on what is happening to 4 stocks that haven't been doing well recently. Well, it's racing time of the year with Saturday bringing the Caulfield Cup, which is the dress rehearsal for the Melbourne Cup in 3 Tuesdays' time. And the great horse trainer of Cup history was Bart Cummings. And he once said, when he reflected on his training of the great stayers, that patience is an asset. And the same applies when it comes to investing. Training a wonderful thoroughbred to win a time-honoured race like the Melbourne Cup, I think, is the highbrow aspect of the sport of kings, while punting is the lowbrow aspect, and it can be compared to speculating on stocks as opposed to being an investor in quality companies for the long term. Now, of course, you can try and trade by buying a stock and flipping it once you're happy with the gain you've made, but timing can be tricky, just like betting on the 4-legged lottery on the Melbourne Cup day. Now, right now, ASIC is watching those dodgy types on the stock market right now because there's a thing called pump and dump. And what's happening is that people are going online and they're using Facebook and Twitter and other online platforms to pump up the reputation of a stock, try and get the whole thing to go viral, and then seeing the share price rise. The people who actually created this pumping then dump the stock to make money. And you've got to be really careful about that kind of speculation. Now, in contrast, I think there is a more patient play that you can do when it comes to speculative stocks. And I think the important word to understand, you can. You can't ever be certain about speculative plays, but I think you can actually look at some speculative stocks and kind of come up with a strategy which I actually use for my speculative plays. Basically, when I invest mainly in good quality companies, especially when the market belts them up. So I loved buying CBA when it was $60 after the Hayne Royal Commission and after the coronavirus. And now, as you can see, it's over $100. That was a very easy play to do. But sometimes I like to buy some speculative companies when the analysts believe there's upside. And I want to talk about a few of those today. Ones that I'm actually I've lost a bit of money in the short term, not much, but just a little bit. I'm hanging on to them because I do believe there's upside for these companies. So let me run through at least 4 that I think are really relevant right now. And the first is Appen, and it has the ticker code of APX. This is a company that has really disappointed the market and has struggled since the coronavirus destabilized a lot of its customers. And its customers are really big ones like Google and Facebook and whatever. And this is a company I think is really well positioned for the future of business because it's in artificial intelligence, it's in machine learning. And as I say, it's got some pretty big customers out there. But the coronavirus really knocked around a lot of its Silicon Valley customers. It affected the share price. I also think the company's probably not doing as well as it should. Also, there are some rumors that some of the big customers might be trying to do themselves their own artificial intelligence and machine learning plays. But I still think that this is a company that when business gets back to normal, it'll actually start to improve. Now, FN Arena is a company that surveys a lot of the analysts of these big companies on the stock market. And there's 4 expert company raters there, and all of them believe this company has upside. The average upside is 44%, but you can see the chart that's on screen right now. I might have to grab my glasses to actually read these. But as you can see, that Citi thinks there's an 84% upside for Appen, Macquarie 27.84%, Credit Suisse 19.18%, and Ord Minnett 46.2%. So Appen certainly is a quality company with a few challenges now, but over time, I suspect it will beat those. And really, I must admit, I hope the Citi analyst is completely on the money with that 80% plus call. So, by the way, just as I was writing, I checked out the performance of APX share price today, and it was up 6% today, which is a nice little start. But there's still a long way to go to get back to its former heyday before it fell out of popularity on the market. Now, another company that I'm prepared to do the Bart Cummings patience thing with is a company called Nuix and Excel. This was a $5 stock that after listing spiked to $11.84 before management was accused and found out for misreporting, and it led to a huge sell-off. It's now $2.52. But analysts believe the company has a target price that suggests it could go up 156%. That's unbelievable. I always say when I see these big numbers, well, you're only half right. I'd be happy with half of 156%. Now, unfortunately, there's only one analyst covered by FN Arena, and that's Morgan Stanley, the big US investment company. And they obviously believe there is potential for this company. Nuix specializes in transforming massive amounts of messy data from emails and social media, communications, and other human-generated content into searchable, contextualized information. And it has huge customers in both the public and the private domain. And it was a huge, it was a hugely successful company until all this misreporting really lowered the boom on the company. And when you think about this, these huge customers potentially, they're not going away. So in a sense, it's been the market's fear that they can't trust the reporting that has really damaged the company. The fact that they've got these big customers out there makes me think that the potential for the company still is certainly believable. And also there are a lot of really smart people from Macquarie that have been associated with this company. Their reputation has been dented as a consequence of this problem with the company. And I suspect one day this company will certainly reassert itself as a quality business. That might take some time. Have a look at the chart. That is a really very, very sad story. And I think investors will need some Cummings patience to wait for it to come back to its former glory and maybe take out a win on the stock market. Now, the next stock that has been pretty disappointing as a performer, I guess is a bit like a horse that's out of form, is A2 Milk, which actually has had a couple of good days this week. In fact, the month's been pretty good as well. This chart here graphically tells you the sour story of A2 Milk's great reputation as a quality company going off the boil. You can see that it was once upon a time a $20 stock. It's now hovering around the $6 space or maybe a little bit higher, but that's basically where it is nowadays. And, it's really struggling to get back to its former glory. The company has gone from greatness to a stock price smashing that usually is reserved for second-rate companies, not quality performers. And the company now has to contend with a class action taken out by the law firm Slater and Gordon because the lawyers say the company misled investors. Now, despite that, the share price has bounced back over the past month, as you can see there. I've actually pulled out the monthly chart for A2 Milk, and you can see it has improved. If you look at the chart closely, it's gone from about $5.50, to nearly $7, which is a pretty substantial bounce. Well, why did the company come undone? Well, the coronavirus was no help. A part of its profit came from the Chinese Daigou trade, where travellers brought back baby formula to China and took it back to sell at home. The company also had inventory issues, and Beijing was encouraging citizens in China to support homegrown products instead of products like A2 milk. And then there were 4 downgrades from the company, and the reliability of the company's reports was called into question. So I guess the question is, why the bounce? Well, this week, a rival company called Bubs Australia announced a better than expected revenue growth number. And this rubbed off on A2. The market thought, well, if they're doing well, even though the companies are not direct competitors, they do rely on Chinese trade. And the fact that one company is doing well, revenue on the improve, has made the market think that maybe A2 milk is in for a bit of a better run. This chart here of Bubs Australia, you can see what the spike has done. Pretty impressive jump. Here, if you have a close look, you can see that the share price has gone from about 38 cents up to about 55. And that's a reflection of the fact that the market is starting to feel a little bit more comfortable with this kind of product. I don't know when A2 will actually be out of the woods, but I am going to give it another year. The analysts who look at these companies as a group tip a 12% fall in the share price for A2. And some even tip a 20% fall. So the story is not as good as the other stories. But these people, these analysts, are more short-term compared to a long-term investor like me. As I say, I'm prepared to give it a year. Those forecasts put out by the analysts are for a much shorter time period than 1 year. Inside a year, this might give us some time to see Chinese tourists come back to Australia. The Daigou trade may well be revamped. And as I say, you might need 6 to 12 months for that kind of thing to happen. I guess on the other side, you've got to understand that Beijing could easily discourage Chinese tourists to come to Australia, because Australia and China have a few political and trade issues at the moment. It does raise a bit of a question mark over the potential of this company. I do go back to the bottom line. This is a quality company. I know a lot of Australians go into their shops and they look for A2 milk because of the very brand establishment that A2 has created around that mystique of A2. I suspect the future will be good for this company, but it just might take some time before that future comes to reality. Now, my final patience play is Fortescue, or FMG. The consensus of our analysts think that this is a 26.8% upside company, and Ord Minnett is far more confident. He thinks there's 74% upside out there to happen for the company. The iron ore price has fallen recently, but I think FMG will benefit from the economic boom of next year. And after the February Winter Olympics in China at the moment has the Olympics coming up. They want the skies to be blue, they want the air to be clear. And so a lot of the heavy production that China's famous for has been toned right down. That's had an impact on the iron ore price. I think once the Olympics is out of the way and China looks at this Evergrande property problem and how it could potentially slow down China's economy, could start ramping up the production of steel for modernisation projects, infrastructure projects as well. And all those sorts of things, I think, could be good for the iron ore price, could be good for the bottom line for a company like Fortescue. And I think that's probably one of the reasons why I believe this company has a much better future come 2022. 5 out of 7 analysts see a higher share price going forward. Here's a chart for Fortescue. You can see it has had a history of bouncing back after sell-offs, and I suspect this will happen. The company will have a better period, 2022, 2023. This 5-year chart shows the bounce back history, and I also like the fact that Andrew Forrest, the chairman, is out there at the moment pushing really hard for his company being diversified into green hydrogen energy. And that does add diversification to the Fortescue company and its revenue and ultimately its profit. I don't expect a big gain for Fortescue soon, but with Cummings-like patience in 2022, we should see some nice results. So that's my collection of interesting companies. I think they have potential. It does require patience, but they certainly are worth a look at and worth considering if you're trying to find companies that will potentially do well over the next 12 months or so. Now, coming up, I've got the chief economist of Westpac, Bill Evans, and Bill Evans looks at 2022, and you'll be really surprised how fast he says the Aussie economy is going to grow. And remember, if the Aussie economy grows fast, it's got to be good for company profits, and ultimately that must factor through into share prices as well. So coming up after the break is Bill Evans of Westpac. Well, joining me now is the chief economist of Westpac, Bill Evans. Hi, Bill. How are you?
I'm great, Peter, and it's good to see you again.
Yeah, same here, mate. Now, look, a lot of us people are kind of hoping that 2022 will be a strong economic rebound year. Is that what your crystal ball is telling you?
Oh, I think so, Peter. Yeah, we're expecting growth of 7.4% through 2022, but that's off the back of a 4% contraction in the September quarter 2021, and a relatively tentative recovery in the December quarter. A number of factors. I think people will be quite tentative to begin with, to go out into the society. We're seeing that the government's withdrawing the disaster payments pretty quickly. So I think that the recovery will be much slower than we saw, say, after the lockdown in the June quarter last year, but it'll build momentum through 2022, and we'd be looking for the unemployment rate to get down to 3.8% by the end of that year.
Bill, you and I have been talking for decades. We would never imagine you'd be talking about 7% growth. Even your unemployment numbers are extraordinarily low. What's driving the fact that unemployment can get so low?
But Peter, let's look at what we've just come through. So in the year to June 2021, the economy expanded by 9.4%. So the 7.4 is, when you're coming out of lockdowns, you can get these spectacular numbers.
Yeah.
And also the unemployment rate fell from 7.5 to 4.5. So I think we'll start this year at about 5.1. Obviously, a lot of the weakness in the labour market will be taken up by a fall in the participation rate. But as we get back to strong demand for labour and the participation rate rises, you'll still get lower unemployment rates. So that's a key factor. And of course, it's being driven by a very different environment than we've seen in the past because of these supply shocks on the supply of labour, closed foreign borders. And of course, what we don't know is people that are not getting vaccinated, what impact will they have on the supply of labour? Will they be freely available to join the labour force if they're not vaccinated? We're encouraged by our sentiment survey that we released this morning, where we're down to about 7% of our respondents that are adamant that they won't get vaccinated. So it's not going to be as big an effect as we thought maybe 3 or 4 months ago, when we had 20% who are opposed to getting vaccinated. But I think it will be a factor. So those two factors, along with strong demand and along with what we've seen, the impact that tight labour markets have had in the last 12 months, give me that confidence.
Bill, are you worried that we're seeing in Europe, the US, UK, there are supply chain problems that is causing growth issues and also inflation issues? Do you think this is going to be something that will dog us in 2022? Or possibly because of the lockdown, which has slowed our recovery, by the time we start getting stronger, maybe a lot of those supply chain problems will have been sorted out?
I think there will be some there, without a doubt. But I think people talk about stagflation, and you remember the 70s, and the world was a lot more oriented towards goods than services. So now it's very much a service-based economy. And so those shocks to goods and the shocks to energy, I think, are less important in terms of holding back the economy. But without a doubt, we will continue to see those supply restrictions going through most of the year. And of course, what that means is that this mix of supply restrictions in the goods sector, supply restrictions in the labour market, and strong demand, as you said, that'll mean the Reserve Bank will reach its inflation target much earlier than it's expecting. And I would think that we'll get the governor will hit his 2.5 by the end of next year.
So you're saying you're expecting interest rate rises in 2022, and we know the RBA has been suggesting it might be 2024. You think
first quarter of 2023, Peter. So once that print comes through, and I would expect it'll come through in January 2023, a confirmation that the trim mean that they use as their key indicator has hit that 2.5% level. And bear in mind that we haven't seen that since 2014. So you can see why they're cautious about predicting an earlier return to those levels. So, but that strange combination of strong demand interacting with restricted supply, both in labour markets and in goods markets, I think it'll be enough to get that number over the line.
How many interest rate rises would you expect across 2023? Because we often see when they start, they often give 3 in a row, but times are different.
Look, Peter, I would tend to try and work out what do we think the peak will be. And the peak will be dominated by the build-up in household debt. So we'll reach a point when the household servicing ratio will reach a point where the drag on the economy will be sufficient to signal to the authorities that you've done enough. And if you go any further, there's some real risks involved because, of course, house prices will continue to rise through this year and into next year. So we're going to see a fairly vulnerable household sector once rates start to rise. So I would think the peak will be about 1.25% by the end of 2024. Now, market pricing in early September was a peak of 0.9. Today, that's up to 1.4. So the markets are already getting excited that the cycle will be larger than I was expecting. We're being criticised a month ago to saying you're too aggressive. Now the market's on the other side, and I guess that's reflecting the points that you raised about the lift in inflation.
Yeah. Do you think the inflation is going to be transitory, or do you think it may well be baked in a lot longer than economists have been predicting?
I think the energy story will hold up for longer because the supply response will be restricted because countries are looking towards achieving their net zero emissions targets. Yep. So a lot of the capacity in the coal and the gas sector have been restricted. But I think eventually you'll find that things will settle down, but there will be that second order effect. So the Reserve Bank and the Fed trim out the big movements in inflation, but the research suggests that there is a second order effect from those big spikes that stays within the underlying story. That'll give you the number because, of course, headline inflation in the US now is 4 or 5% and in other countries, and that's not going to be sustained, but there will be that second order effect.
Have you been able to get your head around the implications of when foreign workers return to Australia and before they do, the impact it's going to have on the labour market, impact on wages, impact on inflation?
Oh, yes. Well, we released our ACCI Westpac business survey last week, and we asked them a question that we like to ask is what's affecting your ability to make sales. And at the moment, it is shortage of labour at sort of record levels. And we keep hearing about these issues. We saw this huge rise in vacancies before the recent lockdowns. Clearly, there's this mismatch between demand and supply of labour, and that is going to mean that we will, I believe, we'll start to see some upward pressure on wages.
Okay, and that, that's the old classic cost push inflation. Is that going to, do you think, lead to a wage price spiral?
No, I think after 30 years of low wages growth and low prices growth, expectations are still pretty low. So those days of the 70s where an employer felt, well, yes, I can afford to pay away those large wage increases because I know I can pass it on in my prices. I still think we're a long way away from that. So there will be an element of that, of having to pay up for certain strategic workers. But the idea of a huge lift that can be all passed on into inflation, I think we're well and truly beyond those days.
Right. So, Bill, looking at your view on economic growth, what's going to happen to interest rates, what's your expectation for the stock market, at least in 2022? I won't push you into 2023, though you're probably good enough to get that right. But the immediate 2022, I personally am reasonably optimistic with more volatility. But what's your view?
I think one of the key points, Peter, is that the big unknown is what happens in China. And my view is that Chinese authorities, they do have the capacity to settle down these two big shocks that they've had in the energy sector and the property sector, if the desire is there. And I think whilst there is a great enthusiasm for reform, I think that stability will still be the key driver. So the way they're dealing with Evergrande at the moment, separating it out, supporting Evergrande, trying to make sure that the problems don't feed into the rest of the economy, and they've got the firepower to do that. On the energy side, let's get that coal back. We understand that reform is important, but this is a real shock. So we'll encourage the re-mining of coal and that. So I think that will be that. So the China story that sits as one of the major issues, I think, will be dealt with. The bond market story, most of the rise in bond rates, I believe, should be more to do with growth than it is to do with inflation. And so what we have to look forward to is that when the Fed moves away from quantitative easing and starts to taper, which we expect in January next year, you'll find that real rate, so the difference between the inflation component and the nominal rate, will have to move back into positive territory. The moment's negative, it's -1. So if you expect inflation to be at about 2.25, the bond rate had been holding at around that 1.3, 1.4. It's now up to around 1.5, but it's in that territory. That's an unrealistic situation. So I think that as we move into next year, we get positive real rates. That'll be seen to be an indication of the growth story, rather than something that is indicating that the share market should fall apart.
Okay. Well, Bill, you've given me a tip on the stock market. For those people who didn't understand, that answer was, yes, you're cautiously positive on stocks for 2022. But what about your tip for the Everest? Because you're a member, is it the AJC nowadays, or they changed their name?
Yeah, well, I was a director of the Australian Turf Club for 7 years, and I spent the last 3 years as the treasurer. So I was heavily involved with all of the finances of the big race club, and it was an amazing time, I have to say. Oh, look, the Everest was one of the things that we introduced during my time, so I'm very proud of the success of that race. Peter, I think the best sprinter is Nature Strip, and you saw that in the TJ Smith last autumn, when it just streeted them. But Eduardo has got this psychological hangover with power over Nature Strip. So when the last time Eduardo beat it, Nature Strip was on the rails and Eduardo was on the outside and worried it out of the race. This time Nature Strip's drawn the 10, Eduardo's drawn the 7. So Nature Strip will be able to bide us time. Don't worry about Eduardo. It'll be on his inside, kick away. So that's my view.
Okay. So that's the economist view on the Everest. Bill Evers, thanks for joining us.
Thanks a lot, Peter. Good to talk to you.
Well, my next guest on the program is Michelle May. She's a principal of Michelle May Buyers Agents. And I want to discuss some of the big issues that are affecting the market right now. Michelle, thanks for joining us.
Always a pleasure.
Michelle, what do you expect? Lockdown is over in Sydney now. What do you expect is going to happen in terms of people showing up to auctions?
Look, from all accounts, from selling agents and just the buyer demand out there from people just inquiring with us, I think we're going to go back to full blown out gangbusters Really, over the last 18 months, the technology online has gotten better, but I think people are going to have more of an appetite to, go through open homes properly, have the time to go through them, and then actually do the auction in person. We have been representing a lot of people online because there is that hesitancy, with the technology side of things. So I do think now that spring is well and truly here and we've got so much freedom, they're going to be good to go.
Okay, so that's the demand side of the equation, and lots of, I think experienced real estate agents have been saying that they believe the supply of properties is going to increase. Is that what you're starting to see too?
Yeah, absolutely. And from my perspective, that's a good thing because there has been so little choice. The quality has been pretty poor as well. So I've been talking to a lot of selling agents, and what we're seeing also coming into our inbox and looking on Domain and Real Estate and all the other portals, there's definitely more choice already because vendors have been holding off, to do a proper campaign, and also because they were nervous not to have choice for themselves on where to move on next. So it's always that chicken or the egg equation. So yes, I'm confident there will be more choice for buyers.
Okay, so there's a lot of concern about the rapid rise in house prices. My gut feeling is that it's more likely that while the supply should slow down the price rises, there's a certain excitement factor when you actually show up and go to an open house and then go to an auction. I guess that enthusiasm wouldn't have been shown online so much. Is that a fair guess / observation?
Oh, absolutely. I mean, auctions, don't underestimate the amount of theatrics that go on. Agents can't wait to get normal auctions, in-person auctions going again because it's a huge marketing tool for them. And that emotion that they can play into from the buyers and that FOMO is no more present than when you're standing amongst other people who are also registered and, with their family and supporters. So absolutely, I do think that while supply is going to sort of slow down the increase, I don't think that it's actually going to make much of a difference, to be honest.
So you're not expecting buyers to see a real lot of relief out of the market, at least in the short term?
No, unfortunately not. I wish it was the case, but no. I mean, if you're looking at auctions, I did an auction in Wollonga only last week. 52 people were watching that auction. More than 20 people were registered. And this is not uncommon to have more than 15 registered people at an average auction. So I think that the prices are really only going to come down from, things like APRA putting the reins on the banks and just slowing down the amount of money that people can borrow. I think that's probably going to have a bigger effect on, buyers going crazy than more the supply side of things.
Okay. Now, I'll give you an example of a question that someone put to me. When people assume that you're allegedly an investment guru, they'll ask you any question, presuming that I can come up with a 100% answer. Of course, I said to them, what I'm going to give you as an answer is not advice. It is just my best guess. But you're in the market, so I'm going to put the question to you. Mm-hmm. This person has done a development. They have 50 apartments in that development, 1 and 2 bedroom apartments. And her question to me was, should I be trying to sell them now or wait until 2022? Now, my best guess was there's probably going to be more enthusiasm now than there will be in 6 months' time and 12 months' time. What would you say?
Look, I think it's dependent on where this development is located because it's all about supply and demand. So if there's lots of other developments and new properties already for sale that are very much comparable to what she's trying to sell, then you need to take that into consideration. But I would agree with you that the appetite at the moment is still very high. Also, next year we're going to have elections, which usually slow down things for property. You know, everyone is holding their breath. I'm not quite sure what for, but you know, it always slows things down. So I think if you're ready to sell now, then why not sell now? You know, because a bird in the hand is better than 10 in the bush.
Yeah, I think you've actually just rewritten that old saying, but still, it works. It works for me. I think also you made the point earlier that APRA is going to get involved in this market, and they'll make it harder for people to access money. And that could be, well, obviously, they want it to be a break on house price rises. So in many ways, if people hang on, they might get higher prices in the future, but the rate of rises are going to slow down, aren't they?
Yeah, absolutely. And I think that, you know, your development question, you know, if it is 1 and 2 bedroom apartments, that they are most likely to be most attractive to first home buyers, who are obviously going to be hit the hardest by the APRA changes. You know, 5% change in borrowing capacity is going to make a big difference to them. So I do think that the changes that are going to be made are going to be hit those people with the smaller budgets first. And so, you know, let's see what next year brings. But at the moment, market conditions are still very tough.
Okay, and let's just differentiate between homes on a block of land and apartments. Is the enthusiasm for apartments the same as it is for homes as opposed to apartments?
It wasn't, certainly because of COVID. You know, people have been reassessing what they want from their property, and certainly having a patch of dirt and an extra space for a study or somewhere for the kids to learn from home has been crucial for many people looking. But I think affordability has now changed things, where people were much more reluctant to look at strata living, you know, apartment townhouses previously. They're now simply being priced out of buying a house, a Torrance type of property. And so their efforts are being redirected to the apartment market. And I do see that apartments are performing better than they were, say, 6 months ago.
Okay, one last question. It's all related when I think about it. As I was listening to your answer and considering that the person who asked me that question, you know, wants me to be right, and I've shoveled the responsibility onto you, so she wants you to be right. I guess if by the middle of next year or the end of next year, Asian students start coming back, they tend to be the sorts of people who chase apartments.
Yeah, that's right. I mean, you know, definitely with the borders being opened again, we are going to see an influx of people looking to buy. And yes, a part of that will be foreign students, and you know, definitely people moving here for work or family or other reasons. So at the moment, we don't have those people there yet. So if you're in the market to buy an apartment, definitely consider, you know, doing it now whilst the conditions, you know, the lending conditions are certainly fine as they are. But yeah, that's definitely going to be a consideration for next year. Yeah.
So in many ways, you either move now, or you might have to wait for a year or two to get some enthusiasm for the apartment market like it was before the coronavirus.
Yeah, I mean, look, I think buyers sometimes forget that the market doesn't really care about them. The market's going to keep moving the way it's going to be moving. And so I think as long as you have your finances ready to go, you know, you're financially secure, I think do your research, you know, go out there and see what's out there. And if you've come across the right one and it stacks up, go for it.
Michelle May, thanks for joining us.
My pleasure.
And that was Michelle May of Michelle May Buyers Agents. Thanks for joining us on the program. If you want to know more about Switzer, you can go to switzer.com.au. I write a piece every day. And if you want to know more about the stocks that we're interested in, have a look at the switzerreport.com.au website, and you can take out a free 21-day trial of the report. Once again, thanks for joining us. I'll see you on Monday night.